Hey there, welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. I hope you're all doing very well. Got another update today. We're coming into Q1 of or Q4 announcements of earnings seasons for some companies coming into Q1 of 2022. And so I'm going through, as you've seen, a number of updates now, going through the top positions in the portfolio and saying what I think about the companies, what's changed since I gave my initial thesis, and seeing how things have played out. So far, as a portfolio manager, things are going very well. Couldn't be any happier. We're up, as I recorded, 2.68% on the month, I believe. So obviously we want to keep that performance up. And today we're talking about Wallgreens Boots Alliance. Okay, so as you can see here, it's a close of US markets down here in Australia. The UK markets are open. So some of these UK listed companies you'll see are trading away in the background. So I've allocated over 5.5% as an initial weighting to Wallgreens, which has since grown to over 6%, so 6.25%, and I think it's got a long way to go on the upside. Super solid business, and it's just one of those that will tick away, relatively recession proof. And so let's talk about the news. There has been quite a bit of news for Wallgreens, and we'll talk about what that means for the future. So as we get into it, as always, if you haven't already liked and subscribed to the channel, we greatly appreciate you doing that. Thank you to the new copiers. So if you don't know, I manage portfolio on eToro and been doing that for, I think, just over 6 months, and things are going really well. So if you want to add the portfolio to a watch list so you can keep an eye on the positions and the performance tracking and all of that, click on the link that'll be in the description and you should be able to keep track. And if you're looking to invest in a value fund, obviously you can use the copy trading function, and so you can copy all my trades and share in the performance. Having said that, let's get into it. So Wallgreens Boots Alliance, our position is up a little over 19.2% in a matter of months. So obviously that's a really great return on an annualized basis. Let's talk a little bit about what my initial thesis was with regards to the company and news. So let's catch up on the news. So our average entry price for those following the Crisis portfolio, my entry price was $45.62. That's the average entry. It's currently trading around $54.32. So we're up 19.2%, as the slide before suggested. So some news, big news. Management have stated their strategy will focus more on healthcare. And so they, as far as I can tell, are looking to move more towards a CVS model, CVS being the biggest pharmacy chain in the US. They have a broad spectrum of opportunities. In my initial overview and analysis of the business, I described Wallgreens as like a pharmacy cross with a supermarket, and that's kind of what they are. What they're looking to do, though, now they're really looking to zoom in on the healthcare applications and kind of scale into that. They're scaling out of some of the other integrations in their business and focusing purely on that healthcare. So the company sold the European distribution business Alliance Healthcare for $6.5 billion US, and so that's already done. What they've done is they've taken that and paid down a heap of debt. So they, a lot of people, as you would have seen in my initial video, giving an analysis on the company, were worried about the debt levels. I was not worried because although it was above our normal net debt to EBITDA levels, they were about 5.7 if I remember correctly. If you looked into it, the maturity, the debt structure was formed in such a way that their repayments were very low, and so they were making low-term repayments because the maturities of the debt was stretched out over such a long time. So they did have a large amount of debt load in total in the aggregate, but when you looked at the serviceability, it was quite apparent that they would easily be able to service the debt. So now they're in talks of selling or spinning off their Boots part of the business, so the UK arm. That is, estimated somewhere around $16 billion worth. So there's quite a bit of shareholder value to be unlocked there, and this could be really interesting. I hope what management do is that they do go ahead with the spin-off as opposed to sell it to an outside party, because then Wallgreens shareholders can be the majority shareholders in the new spawned company. And so this is where you can create some really good shareholder value for the long term. So if I were running the company, that's what I would do. So hopefully they look towards doing that if they decide to make a move. And here's a quote from an analyst. However, it is accurate that Wallgreens Boots Alliance announced a renewed set of priorities and a strategic direction for the group in October, which includes a more pointed focus on North America and on healthcare. So summarizing what I just said, they're looking to scale back in terms of UK and mainland Europe and focusing purely on the healthcare side of the business. Looking to compete with CVS, Wallgreens and Village MD are slated to open about 1,000 primary care practices by 2027. That strikes me as similar to a lot of what's happening in Australia. You have a few publicly listed companies looking to roll up not so much medical practices or pharmacy practices, but certainly allied health practices. And so what this sounds like to me is that they are going to have a one-stop shop where you have eventually a fully integrated GP diagnostics and pharmacy, probably radiology as well if they get that far, in one hub, and they'll start to streamline the businesses to make them extremely cost synergistic. And so I think that's the direction in which they're heading. They've already rolled out these in, I believe, Florida, and so that'll be interesting to keep an eye on how this slight change in direction does occur. I suppose if you look at CVS, there's a CVS on basically every corner in every major town and city in the US, and I'm sure that Wallgreens are trying to emulate that, and I'm sure that as part of that they'll look through their product line and scale back on more of the grocery side of things and look to really focus in on the drugs. Here's the original slide giving my bare bones thesis on the company. So what I thought was a major advantage for Wallgreens was because they were being used as an administration site of the CV19 vaccine, they essentially had free traffic. So instead of having to pay for marketing to get people to come in your doors as a business, these guys basically were beneficiaries of being able to store and roll out the vaccine. People were coming to them on a even more regular basis, and of course more customer trips into the store brings about more opportunistic purchases, and so that increased number of transactions is likely to increase the average transaction value for a given customer in, let's call it a 12-month reporting period. It does seem to be occurring. Let's see, was that accurate? The company's raised guidance, so they've had almost an 8% sales increase in the USA, so that seems to be corroborating a thesis. 35% international sales growth. So that's interesting. I mean, they're looking to scale back from international segments, and yet that does seem to be growing at quite a decent clip. Their cost reduction program is set to save about $3 billion or more by 2024. So they're obviously looking through the business. They're not a startup business by any means. Instead of looking to acquire more businesses, they're actually going the opposite way and saying, okay, what are our higher margin services or goods that we offer? Let's look at the 20% that gives us 80% of our gross margins and focus in on those. We'll spin off the other 20% and we'll really get focused, really get lean, and start to create and free up a lot of cash flow and give that back to shareholders. Or I hope that will be the next step. That's what it looks like where they're heading, and so I'm excited about that. When you have an established business that's already undervalued, which they're growing at a decent clip, the question is, how do management treat the owners, which is us? We're the shareholders. Are they doing stupid things with the money, i.e. going out on massive debt binges on capex and acquiring all sorts of other businesses as acquisitions that don't make sense just because they want to make the news? It doesn't appear that Wallgreens are doing that. It appears that they're thinking about the owners and starting to solidify the business and free up the cash flow as a percentage of EBITDA. So reduce net debt by about $7 billion over the last year. Net debt to EBITDA is now down to 3.7. Okay, so really good signs. The management are behaving responsibly, and that is exactly what you want to see. Well, that's what I want to see anyway. Okay, so let's move on to the next slide and see. Here's the original projections for the end of 2022 2022, and then I've gone and scribbled over that with the updates with the company raising guidance. A few things to note. Obviously, I've just put in the numbers here for EBITDA on a per share basis and the earnings. I've upgraded the multiples that I'm using. Why? You'll see in a moment. Comparing CVS to Wallgreens, you'll see that it's much more analogous to use an 11 times multiple for free cash flow. The way that the company is spinning off value and creating shareholder value is also another reason that the market will be looking to potentially pay a little bit more for the earnings. And of course, one of the reasons why it had a lower earnings relative to its peers is because of the debt. But if they're paying down that debt, all of a sudden the market will view their cash flows as far more attractive because there'll be much less risk associated. So when you look at that, the average implied price is $86.90, up from originally $77.30. The price has run up, and so it's actually about the same in terms of the upside from here. So although the price target, if you want to call it that, has increased to $86.90, the current price at which you can buy the business today has also come up compensatorily. So there's still about a 60% upside, in my opinion, for Wallgreens. Okay, here's what I was speaking about before. We've got Wallgreens, we've got CVS, the two most analogous businesses. Let's look at their enterprise value to EBITDA here. So Wallgreens trading at about 13 times and CVS trading just under 11. And then when we look at the multiples you're paying for the free cash flows of the business, Wallgreens is lagging behind less than 10, and CVS is trading at about 13. I've said that I think that an 11 times multiple is reasonable, and I would expect maybe a 12 times multiple for the EV to EBITDA in terms of a base case, and then I go up for the bull case and down for the bear case, which you'll see in a moment. All right, so let's have a look. Compared on the left here is the original. This is the updated version for the cash flow on the left, and then the EBITDA on the right. So what I've done is taken the outflows, so what we have to pay for the business today, $54.33 a share. These are the expected cash flows based on the projection and based on what I believe a reasonable growth rate for the cash flows will be over the next 10 years, and then times by an exit multiple. So if we hold the business for 10 years and sell it in the 10th year, if we discount that back to today's money using the company's weighted average cost of capital, so 3%, what would that be as an annualized rate of return? Or an internal rate of return is technically the correct terminology. So we're looking at about 19.74. I do the same thing over here, except I use the EBITDA per share estimates. Okay, then I use the growth rate and we discount it back to today. Okay, very simple. From here, we've got a change actually from when I originally did the IRR calculation compared to today. It was about 0.45% better when I originally did it versus today. Okay, so the business is holding up strong, the price is running up, and so if we discount it on a time value of money basis, it's not quite as good an investment today as it was 4 or 5 months ago when I first entered the position. It's only less than 0.5%, and if you're expecting to get 90%, that's not terrible. And so depending on your risk profile, you may be interested in looking at the shares at this price, or you might just want to use that as good information and stalk the business. If it were to drop in price, obviously, then those cash flows would obviously be more valuable, provided that nothing's changed in terms of their projection, and so you'd see the IRR number start to change in accordance with that. Okay, having said that, that's hopefully pretty straightforward. I'm hoping you guys are following. And I guess the only counterpoint to that would be if you take a step back from the numbers and you say, okay, this is the numbers, this is the return I'm expecting. Is it more of a de-risked business now that it's starting to get streamlined? Management have given strong indications that they're shareholder friendly, and they've also paid down a heap of debt. So you could say, look, maybe the IRR is a bit lower, but the company is less risky, or it has less of a debt load than it did when we first looked at it. So that would be a good subjective point or qualitative point to take into account for sure. All right, the original 10-year plan, okay, very skeptical when it comes to projecting out for 10 years. But if you use big margins of safety and your thesis is solid, and then you put it in a correct weighting in a diversified portfolio, things tend to work out reasonably well. Notice the probability weightings. I've changed them with the update, okay? It's a boring business. It's a stable business. It's not going to have major boom years or major bust years, you know, without some kind of true black swan. So I said the intrinsic value looked to be around about $60, so $59.95 when we looked at it last year. And so if we could buy that business there or below, particularly if we could get it below $39.56 for a margin of safety, then we would be pretty confident we could get a 20% IRR minimum if we held the stock long enough for the market to value that. So let's have a look at today, and I've changed a few assumptions, and you'll see what that does. So I would say, as I look at it now, I would say this is a fairer probability in the sense that it takes into account more of a bear case, so it gives it a whole nother 10 basis points in terms of probability. So it's obviously more of a conservative valuation. And if you look at the multiples, you'll understand why I put them in now, having spoken about that in the previous slide. The growth rates. Management, if you read management's guidance, they expect sort of low single-digit growth rates. And what does that mean? Does it mean 6? Does it mean 5, 4? 9 is technically single digits. I've gone as a base case with 3% for the growth of the EBITDA. It was slightly higher for the cash flows. I think it was about 4% because that was in line with its historic growth rates. But if you think about 3%, it's really only growing just a tick more than the economy, okay, than GDP. So that is a very low hurdle to surpass. And so I think that this is a conservative valuation, and that should be taken into account. So let's see, based on this conservative valuation for enterprise value, free cash flow, and the earnings, we would expect to pay no more than $57 as an intrinsic value for the business if we want to get our expected 20% return. And so anywhere south of $37.64 would suggest a really, really solid buy if you believe these numbers and your due diligence shows you that corroborates something similar. So what's the plan? At the moment, we're sitting pretty. We've got a healthy amount allocated to this particular position. It's in the sector. I wanted to buy CVS. I did own it for a little bit, flipped it for a quick profit because it had run so much. And so I see it as basically one of the two. So we own Bristol Myers, which is big pharma, but mainly kind of biotech. We also own BioNTech. So we've got the biotech and drug development pipeline well and truly covered. We've also got the distribution covered in terms of Wallgreens. So I would like to keep a position in that sector and have exposure, unless the stock just runs away. So I won't look to start trimming until the stock runs to about $75. Then I'll start to scale a little bit, depending on what's around. So if I look around and there's no other reasonably valued company or better opportunity, particularly in the sector, then I may not. We may just have to sit back and be patient and wait, hopefully, for the business to continue to realize its value. It will depend on opportunity costs at that time. So thank you very much for watching. Please like and subscribe if you haven't done so already. And if you're interested in copying the portfolio, click on the link below. And if you set up in eToro, all you need to do is hit the copy button. If you don't have eToro, you can download it. You can check it out. It's just a brokerage. It's a very good brokerage. And you can keep an eye on things, if nothing else. And I am on Twitter. I'm not very active. I tend to use Twitter as more of a reconnaissance tool than anything else. And so, having said that, guys, a disclaimer as always, I'm not your financial advisor. Nothing I give is advice. It's just my opinion. I'm just a guy that loves investing, and so I'm just showing you what I'm doing and what I enjoy doing and what I'm doing with the money that I manage. But I don't know your circumstances, so you need to be responsible for decisions which you make. And understanding that you shouldn't just take what you hear on the internet is gospel and go and act on it. You need to do your own proper due diligence, and that might mean seeking proper professional advice for someone that knows your situation, which obviously I can't from this side of the internet. Having said that, I hope you got some value out of it. I hope you enjoyed it. If you're interested in a certain company and would like to discuss it, if you have any questions, drop them in the comments section. I really enjoy the discourse that goes on in the channel. Get some great feedback and great conversation. I'm going to leave it there. I look forward to seeing you soon, and all the best until then.